which is a startup. Thank you for coming today. I'm going to talk about the technology of an equity trade. And I'm going to do it a slightly different way around. So start from the business and go to the technology. I think you've had a few sessions today where there's been technology tracks that have related themselves into the banking business and kind of a little snapshot view. I want to try and join the whole thing together from a different perspective and leave you with a challenge at the end. I'm John O'Hara. I'm CEO of TaskGuys, which is a startup. For the preceding 20 years, I was in investment banks. Well, it wasn't the start of my career. I started in Ford Motor Company, and I'll come back to that one as well. And it ended up that I was lucky enough to be chief architect for global equities in 2 tier 1 banks. And this is anonymized, so things I say here are not particular to any of them. It's really important to know that. But I can talk about it. I'm not under the ogre of corporate communications that many of you probably know. So I want to start with a question, and that is, how many people here work in the banking industry? That's about half of you. How many people are interested in working in the banking industry and don't know what's really in there? That's about a quarter of you. Right, so that's useful. How many of you are on the I'm not going to ask the technology side. How many of you do equities? Right, so if I do anything wrong here, no correcting me. Excellent, that's really useful. About a minority do equities, so you're here to learn something, which is great, and hopefully I'll add some color to it. Now, the banking industry has been under a really difficult time for the last 4 years, and they're actually starting to come out of that in some ways. And in coming out of it, you're going to see that they'll transform, they're going to be different. And it's a really exciting time to be good at technology. And I thought, if you're going to come somewhere and talk to people who are good at technology, where else do you come but QCon? Yeah. So let's start off. I hope I'm not too loud there. Get next. Can I work my slide deck? Right. There we go. Okay, so we're going to talk about. Equity market backgrounder. What are the dynamics of the market? What does it look like end to end? It's the simplest market in banking, other than foreign exchange, which makes it really interesting to understand all the processes that hang together inside a bank. But the things that apply to equities apply equally well to other divisions of the bank, like fixed income or credit. So it's a very good place to start. We're going to talk about the business processes. We're going to talk about the systems pipelines that support those processes. And then more interestingly, for this audience, I think, we're going to talk about which technical patterns fit those processes. Because you'll see there's a tremendous divergence from super low latency stuff, which everyone finds really attractive and interesting, through to quite industrial, high reliability stuff. And they all have a place along that pipeline. We're going to talk about that. And we're going to talk about who the usual suspects are in the technology area. If you were in a bank, who would you probably see in that area in terms of vendors? And at last, we're going to talk about what's happening next in this industry, where it has to go, and put some meat on that. So without further ado, is there a way? Space works. Fantastic. So what is this equity market? This is a fairly recent piece of analysis by the Stock Exchange World. And you see that the largest equity market in the world is the New York Stock Exchange. It does $13 trillion per year of stock trading. The entire market size is $49 trillion. So the NYSE accounts for about a fifth of it. Now, what's really interesting is that doesn't make it the largest market by volume. The largest market by volume is in India. They do 9 trillion transactions, of which 1.4 are done in India. And that makes it the largest by volume. I think that really tells us how the economy is changing around the world and how the Eastern economies are really getting into following along the lines of Western economies and getting into stock ownership. Which is fascinating. At least they've got their scalability sums right. So 9.1 trillion transactions done in the equities market globally, of which 1.4 are in India. So that's an interesting background. Now, what's this process they go through? I'm going to spend a little time talking about the range of how business is done in equities. And if you remember back to films like Trading Places, where they talked about the Chicago Mercantile Exchange, that's commodities, not equities, but it's very interesting to say, you buy up and say, I'm going to buy 1 million shares of IBM, or I'm going to sell 500,000 shares of Coca-Cola or whatever. And it's a very manual process. You'd call up, you'd talk to someone, paper would fly around, people would get very high blood pressure. And that was called single order trading. That's on the near side of this diagram. And that's where things started. Then the markets were electronicified, if that's a word, and everything changed. Suddenly you didn't have to talk to people anymore. It started at the core of the exchanges and spread outwards to eventually the type of technology that was happening in the exchanges for high velocity trading was everywhere. So if we move across this diagram, the next place you see is programs and basket trades. And to put a little bit of context in this, if you have a pension fund or you've invested in a tracker, hope you're lining up for your ISA for next year, you might buy into a tracker fund. You might track the FTSE 100. How does that work? The fund manager you buy it from has bought stocks and shares that reflect the FTSE 100. And every day they have to rebalance that set of stocks and shares. So they'll create one transaction that they'll send off to their favorite bank to make that happen. And that can be, for fairly primitive shops, that can be a spreadsheet. For more complex shops, it's fully integrated. But they come up with a whole list of transactions, maybe 100 trades, 1,000 trades. If you go for the Russell 2000, it's a 2,000 trade basket. And they'll submit it. And they want to achieve the exact performance of the index they're doing. They don't want to trade better than the index or worse than the index. They want to trade exactly on the index. So if you're a fund manager, like Fidelity or one of those types of organizations, you might be sitting on an incredibly large amount of stock to shift across an incredibly large number of stocks. And everyone out there is going to be waiting for you to see you coming and give you a bad price. Your objective as Fidelity is to get that stuff into the market and not move the market. So basket trading is about shifting large orders like that into the market. And program trading, this box in the middle here, program trading system, is about slicing that massive market up that's comprised of all your little pension funds and investments, and this massive combined market up and slicing it into the market and trying very hard not to move the price. And everybody else is watching you. Yeah? So moving along, that's the next piece. Moving along, the bottom here is the market itself. And the exchanges are the part that people know. We'll talk about the other parts shortly. Moving along, then you get to DMA. So if I become more sophisticated as a fund manager, why would I ask my bank to slice this up for me? This is actually the fourth box, the orange box on the right there, no touch. Why would I ask the bank to do that for me? Maybe I'd rather be a little bit more private. Maybe I have special sauce in my technology that can do this better. So I want direct market access. Now, the rules and regulations of the markets are such that none of us could get a seat in an exchange. That's actually restricted to the people who own the exchange, who are the banks. So you have to trade through the banks. So you can ask a bank for connectivity, direct market access, not direct memory access for people in this audience, direct market access, get through to the market and execute those transactions yourself, right? And then you get people working on higher and higher technology, faster and faster technology, better and better algorithms. And the war has begun. Now you're talking about competitive algorithms. So moving to the next stage, DSA, direct strategy access. So you're going to end up with the market splits in two. People who can do this and do it well, and people who can't do it so well. But they still have to carry on in the market. So what they'll do, the people who can't, or maybe don't want to be bothered, this is not their area, they'll delegate running strategies, running program trading, and running algorithms to their host broker-dealer, the bank that's servicing them. And they'll say, almost like a Chinese menu, they'll say, I'll have a number 42 today. Can we think the market's behaving like that? Run one of those for us, please. And then that, of course, has a benefit of you don't have to have the developers to do that. You don't have to have the expertise of maintaining the competitive machinery necessary for that. And also, you're closer to the market because the bank's closer to the market. And then you move across to the high-frequency trading area, which a friend of mine recently said, and I thought this was brilliant, this is the military drone of trading. It's bright red for a reason. So market makers and hedge funds will endeavor to move to the low-latency arm race on the right there, where they get as close as possible to the market, and they allow the computer programs to autonomously trade the market. There's no one in direct control. Now, if you've heard some of the other presentations at QCon, it's great, you can see the presentations going up on the web straight away. People talking about 100 microsecond access to the market. How do you control that? Well, you essentially have to send it remote controls and say, I kind of want you to do this. Yeah? And have safety guards in place that dead man's trigger, if you like. If I let go or if the network goes down, it stops, it kills itself in the market, it pulls out. And the military drone piece is maybe not a bad analogy because recently I think it was reported that a drone came very close to a commercial airliner just in the last week. And there was a near miss. Well, the equivalent of that is that your auto trading system gets out of control. And we had Knight Securities last year who lost $405 million in one day through a programming error. So it really is fairly interesting stuff. And that is attractive from a technology point of view. But obviously, from a business point of view, we have this complete spectrum, and that on the far end only represents a small part. And I'll touch on something really significant. This race for HFT, high-frequency trading, essentially, because it's almost money for nothing if you've got an algorithm that's better and you're closer to the market. This race for HFT has driven costs down, where it's easy for you and I now to trade in the market at low cost, but it's also driven profitability out of the markets for the banks. The structures nearer me on this diagram are now, very expensive compared to the ones on the far side of the diagram. Who's going to trade them? And 60% of the volume in today's markets is driven by automatic computer systems. So going down to the bottom, then we have the actual markets themselves. And there are four kinds of markets. There are exchanges, what everyone's very familiar with. There are crossing networks, which is essentially a company sets up and they form agreements with banks to trade privately. Think of it as more of an eBay for stocks. And then there are internal markets and dark pools. Dark pool is the one that's most eclectic in its naming. What they're essentially doing there is people with very, very, very large amounts of stock to move who really can't afford for anyone to see what's happening. They want to complete a merger or acquisition. They want to do something really large with stocks, and if people saw them coming, it would be real trouble. The prices will all move it and make it uneconomic for them to do it. These dark pool organizations essentially let people meet and discuss, do you want to take these shares off my hands? Now, all of this is regulated. There's a regulatory box in the middle there. And market transparency is retained across all of this in terms of the price that was achieved. The laws were changed and created laws called MiFID and similar ones in the States, essentially to guarantee that people trading in these markets would get a fair price. So if I internalize an order, for example, if you want to buy Coca-Cola and I'm a bank and I have some sitting on my books and I don't want it anymore, I could sell it to you. I don't have to put that transaction through the market. But I must give you a fair price. I must give you a provably fair price. And that provably fair price means I have to photocopy the state of the market at the point in time where I sold that to you and prove that I gave you a fair price, a better price that was on the market. Now, as a bank, I will have benefited from that because I did not incur the charges of making the transaction, and perhaps I helped my own position a little bit, but you did not lose. And that's really important. So these regulations are critical. So that's kind of the scenario we're playing here, and that's what our technology is supporting. And to put some more sort of context around this, the organizations, the technology that supports this, a bank will typically have, one of the top tier banks will typically be employing 150, 200, 300 people in its IT division in this area. So, moving right along. Oh yeah, talking this on the way past. What's the difference between an algo trading engine and an HFT trading engine? An algo trader will do quite sensible things that are intuitive. It'll place an order and maybe it'll get 5 trades off the back of that order. An HFT engine does something entirely different. It chases the market up and down. It watches the prices that are coming in and it makes a market. So the primary reason for justifying HFT systems in banks is there always is someone there to buy or sell from. They are the one on the other side of the trade. But as the market moves, they're always very careful to remain profitable or not make a loss. So they're chasing the market up and down. And this statistic of more than 100 orders yields 1 trade. What does that mean? If I place 100 orders, would I not expect 100 trades? Well, no. Thanks to the magic of something called cancel replace, I can put an order in, notice the market change, cancel replace, and chase the market up and down. And really stay very, very close to where the market is. So this statistic that over the last 10 years, the 10 years leading up to 2010, the market dynamics changed completely thanks to auto trading. The trade size went down as things were divided smaller and smaller, so you couldn't see me coming, so to speak. You couldn't see me entering the market with something to sell. You can't tell I've got 2 million shares to shift if I put in 100. Yeah, that's what's going on there. And the deal volume correspondingly and obviously went up 7 times in that period. And that will have kept going. That volume acceleration has kept going. It's dipped off in the last 2 years, but it's certainly the case that this is not the market that existed in 2000. Now, given this assault of complexity and an erosion of profitability, what do the banks do? Because they have systems that have been built and developed over the past 10 years. They have massive amounts of technology. And it's not really appropriate. And I saw this quote from Lloyd Blankfein, who's the CEO of Goldman Sachs, and I thought this just really resonated with me. I thought, you don't normally think of Goldman Sachs as a cheap company, right? They're a premier investment bank. And he came up and said this: we're much more focused on operations and technology and being a low-cost provider. Now, find the article in the Wall Street Journal. It's really interesting because they're talking about changing the dynamic and focusing on technology and less on the business side. So these are not low-cost people. We want fewer of these. And in the current market, I don't think we're going to have anyone resisting that particular urge. So what does it mean? Well, to look at another premium name, platinum name in the industry, McKinsey. McKinsey's looking at this stuff and say, well, gee, how do the banks react to these plunging profitability? And there are three things they recommend. The first two are capital and business organization related, but we're not that kind of conference. The third one is the time is right to make a giant leap in technology, to become a new firm. So the leaders in banking always find themselves dreaming, I wish I was Google. I wish I was Amazon. I don't want to have the 4,000 systems I have parked out there. I'd rather have this. And they dream enviously but can never put together the business case to do it. The business case now is that 4 or 5 years ago, the return on equity in an investment bank was 15%. That number has dropped to 7%. The cost of the capital required to do the business is 12%. They're in really quite dire situation, and they require great business people and great technologists to take them out of that situation. And that is the opportunity that is gradually opening up in the investment banks. So from 4 years of relative scarcity, you're gradually seeing organizations realize, and supported by quotes like the one we saw from McKinsey and leaders like Lloyd, are encouraging to take that risk. So what does that mean? Well, if we drill down into the technology to support a bank, said we'd talk about the business processes. These are the business processes that make an equity trade happen. They also happen to be business processes that make every other type of bank transaction happen. So if you're in fixed income doing bonds, it's the same thing. If you're doing derivatives, it's the same thing. If you're doing credit, it's the same thing. If you're doing commodities, it's the same thing. All the way down from origination, which is the whole business of persuading someone to buy your product. And there you're kind of running an internal mini publishing house. You're generating research. You're publishing attractively well-researched figures to your clients to say, now's a good time to execute. Come trade with us. Going through pre-trade services, well, I'm someone like a hedge fund. I've got a lot of stuff to put into the market. I want to analyze, based on past performance in the market, is this going to work? My strategy. So we'll do some pre-trade analytics. I'm not going to talk to all these, but the whole price, you can walk through these and find it. These are the terms. People recognize these terms. You want to discuss them. And if you want to ask questions about these at the end, please feel free to. But I don't think I'll have time to go into them. I'll be pleased to hear. So let's focus on the simple one. The simple one is a simple buy an equity. What happens? We talked about the fund manager, and he comes at the front of this process, having to his friendly sales trader. The sales trader is the client-facing part of a bank, the guy who will answer the phone, who will call you up proactively and say, hey, you've not called me for a while. We've got something we'd like to do with you. This is a good idea. Try this. Have some of our research. We sent you some research. Can you use that? Is that good? And they'll persuade things. Then the sales trader will take an order, right? And they'll turn around and hand that off to something called a block trader. The block trader is the market-facing side of the organization. So where the sales trader understands the client intimately, the block trader understands the market intimately, or the sector. So you'll have people who understand Europe, people who understand gas in Europe, people who understand petrochemical in Europe, that they understand the market. Now, in the past, these used to be dozens and dozens and dozens of people. Now, it would not be uncommon for a tier 1 bank to be managing the entire European market with 5 people and an army of auto traders. Moving along, right? So the block traders, they will aggregate this demand coming in from the sales up front, bring it all together into big lumps of stuff to do, and then they'll work out what they want to do to make that happen. And they'll turn around and they'll start feeding this into the market. The simplest way is just to put it through something called a smart order router. What's this about? If I go to an exchange, can I trade this stock on this exchange? Turns out there's about 50,000 stocks in the world that you can trade. There are about 100 execution venues that are public. They don't all trade every stock. But me as a customer, I just expect bank to be able to trade stock. I don't care. I don't want to pick a different bank to trade a different stock. I expect a one-stop shop. Amazon type experience. I've become conditioned. This is banks dreaming of Amazon again. So smart order routing selects the venues. Now there'll be multiple venues, so actually it might fire off to all of them at once, speculatively, and hope it gets a price in one of them. And then it'll cancel the other two orders when it comes in. And maybe it'll buy too much or sell too much, but that's okay. It'll hit a price. It'll smooth it out. Then we move into the exchange. The exchange is the center of this diagram. The exchange is the pivot point of the whole operation. Everything centers around this white-hot heat in the exchange. And essentially, it's matching buyers with sellers. And it's matching different offer and bid prices. And matching is the key word here. And when it finds a match, deal's done, right? And the information that the deal is done, the fill or the execution, will head out in both directions in this diagram. The first direction back towards the guy who bought it through all these different things. He'll tell the block trader, I got that 100 for you, all done, got that, and I got this price. And I'll head back up through eventually to the sales trader and to the client. Now think about selling a lot or buying a lot of stock. Are you going to get one price? Are you going to get it in one go? You're not. So what they do is create a synthetic price, an average price, a volume-weighted average price that represents the transaction you did. And eventually it goes all the way back. And that is the buy-sell side of the market. Now going to the right-hand side, you're into the making it actually happen. And it's quite mysterious to some people how stocks and shares actually move around. So it goes through this process called booking, which means that I actually have it on my books. I recognize what price I got it for, and I'm liable for it. I'm legally liable for it. I must not lose it. In fact, if we add in this piece here, you have two halves to the diagram. Super fast and low latency on the far side, and super reliable on this side. And that dividing line is very, very, very crisp. The second I've told I have a fill, I must not lose it. And it has been the case that people have had unreliable software, dropped an order on the floor, dropped a fill on the floor, not realized they have exposure to the market for a long time, and the market's moved away and they've lost money on it, or made money. But it's very important you don't lose these things. You go through allocation configuration, you add fees, you work out how much it costs to the business. If you bought a very large chunk of stuff, you put it back into the right sub-account. And essentially all this adding up that happened at the start of the process, you're now reversing it and putting everything back where it should have been. So allocation is kind of the opposite of this splitting up process that happened at the front. Then you get into settlement and clearing and the custodian. And they can be quite mysterious. It turns out that all your shares live in one place in each country. So the depository, DTC in North America, has all the shares. They have all of them. And it's just a book entry process to move them from one owner to another. The custodians are banks that essentially look after the pain of dealing with people who don't know how to operate this system. And make sure all the data is correct, make sure it's right, make sure they're following the laws, make sure things are reported, and it happens. And that is your flow. So let's add in some more technical observations first. There were 7 places here where an order kind of got messed with. And by messed with, I mean we took something in and then we turned around and repackaged it in a different way. Took little orders, repackaged them into big orders. Took big blocks, repackaged them into little orders into the markets. Yeah? And then again, the fills. We took the little fills and repackaged them back to the block that they're associated with, and we sorted out the price. And then we took the big fills and allocated them back to the client who had them. There's a lot of matching and states machines and all sorts of stuff going on here. And what's really fascinating about this industry, and seems slightly mad to IT people, is each one of these can be a different system or owned by a different organization. Each part can be owned by a different firm. So how do you integrate this? Well, we have FIX, Financial Information Exchange. Originally stood for, I believe, Fidelity Information Exchange because they invented it. And it's now dominating the markets. Everyone used to have proprietary ways of doing this. Now it's FIX. And it's really good. It's really ignited the market being able to do this. But that idea, that concept, I think is quite interesting technically. The fact to have this order management unit that's repeated over and over again in different ways. And matching is the name of the game, matching sellers and buyers. So let's go into more interesting pieces again. And I need to pick up my rate here. So you don't just trade in exchanges, you can also trade on these MTFs, these dark pools. the crossing networks, so there's lots of places to trade. This takes the number of venues up to about 400, right? And your smart order router is trying to work out what to put where. Well, the smart order router is such a great idea. Let's give the DMA guys access to that. That's what you're selling, to give the fund manager direct access to your connectivity. You've got the market data all emerging from the markets here. You've got to record the market environment to justify you give your guys the best price. This here, the tick database, could easily be 200 terabytes of time series data. So we're starting to get to different types of application technology, different types of architecture supporting what's going on here. Then you move on to the program trader. This is the sort of continuous, the CEP, complex event processing type engine that's slicing and dicing stuff up, sliding it into the market so that people don't see what you're intending to do, so you get the price you wanted. And then we get the high frequency trading piece. This is the remote control drone that's in the stock exchange with the 150 meters of cable coiled underneath. Why is there 150 meters of cable coiled underneath that particular cabinet in a stock exchange? Well, they guarantee that everyone gets exactly the same cable length between their server and the exchange. It's got to that degree of competitiveness. People will buy special network cards. They will buy fiber optic connections to nuclear clocks to know when trades happen. It's an intensely competitive place. So we'll come back to that again later. And so these are the different types of things you'll find going on here. And what's really interesting is, and I don't have time to go into all of them, but let's leave time for questions. So if people have anything they really want to ask, let's do it that way. But to pick a few out, I would have, in-memory databases and sort of lossy technology. The far side of the diagram is typified also by the fact it only lasts for one day. The far side of the diagram lives in Groundhog Day. Every day is a new day. It's wonderful to do technology on the far end of this diagram before the exchange, because you don't have to think about legacy. It's wonderful. The other side's harder. The back office side is definitely harder, because you're tracking 200 terabytes of market data. What if you change your mind about how you stored it? You're not going to go back and redo it. That's kind of a big data problem. You also have all these 7-year records of things and big transaction processing systems. You might have Exadata, things like that in there. Long-lived workflows. So the workflow at the front of this is short-lived as you pass things back and forward during the day. At the back end, it's T+3 settlement in some markets. It's a longer thing. Check the regulations. Whose bank account was that we're paying? What was the ISIN code of the stock we did? Was that right? Did they make a typo? An awful lot of people, many, many, many people work back here, patching up the errors that happen in the front. So at the front, you'll see in-memory databases, high-speed journaling, and you'll see an awful lot of C#. The front of because of Windows and Windows desktops and having a great user experience, that leaks its way all through the front end of most trading shops. The back end, much more enterprisey, much more Linux, much more Java, much more application server type stuff, much more relational. So you see this very clean gap. And as mentioned earlier, the specialized 10 gigabit network card with super stability, very fast offload engines. And you'll even see people writing fixed messages as pre-prepared network buffers, so they can bypass the TCP stack. It's properly hardcore. So the usual suspects. These are the companies you'll come across. I've got a nice little disclaimer here in very dark gray at the bottom. I'm not recommending these people. But if you go into a bank, these are the names you'll hear most often. We talked about .NET in the front already and the sort of more traditional technologies at the back. You'll see the usual things. I think what's interesting to pull out here is we've talked briefly about special hardware like SolarFlare or Soleus networks, or hardware network accelerators to increase the velocity of things between these different pieces. Co-located. I mean, vendors will essentially boast about the fact they've put an entire network into a box. You think, hang on, that's not a network anymore. Some other interesting ones, obviously Bloomberg and Reuters and a few others as the main providers of very large amounts of market data into the system, so you know what you're trading against, what the prices are, depth of market. But when you're doing HFT, I'll touch on this, you won't use those feeds. When you're doing HFT, you will take the feed directly from the venue, and it'll give you a much higher degree of fidelity into what's happening in the market. In fact, you can even see, say, the top and bottom, the top 5 orders on both sides, so you can get a sense of what's coming into the market and get an idea of where you should be placing your prices. And of course, all this information advantage can be bought by anyone, but it's expensive. KX is interesting. I think it's always really interesting. It's an offshoot of APL. It has its own particular language. It's a time series database. And it's remarkable what someone skilled in the art of KX can do with market data. I'll mention C24 because it's Mr. Davies' company, but it's a really useful product. It takes the knowledge codified in Swift, which is, if you print out his manuals, is 6 feet long, and puts in a set of libraries. I'm glad someone else did that. AMQP I'm going to mention on the way past because this is a massive integration problem, and what encouraged me to do AMQP back in 2003 when I was chief architect for equities at a firm was I was getting fed up with just how difficult it was to plug this stuff together. And it's not something any one firm can solve. It needs to be solved on a larger scale. So I'm delighted that that continues to this day and keeps gathering momentum. It's great to see that people are using RabbitMQ here, but it's not the only one. So that's the type of space you have there, and things like Apama and other CEP-type engines like Streambase. So lots of stuff going on, and these will just come up, but they're not the only ones. That's not an advert. So, in context, the technology I talked about, I mentioned it would be 300 employees, would support a cash equities trading system in a tier 1 bank. That's just one part of the equities business, and the equities business is just one part of an investment bank. It really scales up. And you'll find an investment bank will be sitting there with, easily between 1,000 and 2,000 systems. And depending how you count, some banks will count this at 4,000. They will have between 8 and 10,000 technology staff, roughly. It could be higher than that number. I'm deliberately not being very, very precise here, but this gives you an order of magnitude. And they will spend $1 billion a year on the investment bank technology stack. Now, that's not servers. That's not data centers. That is people like you and me. They're paying for software development and maintenance and keeping up with the developments of the markets and the evolution of the markets. And the biggest driver now, the driver of the regulators. The regulators are getting complete transparency in the markets, and when they say, jump, the banks ask how high. It's absolutely the focus. But that in turn is driving transformation. It's driving the Gugazon effect, because now banks have a business case better than they ever had before to be really on top of their data and really on top of their processes. So that's the investment bank, that's equities. The investment bank is part of the mothership. People don't often see the mothership. Investment bank is, if you're one of the top 10 banks in the world, a global bank they call them, you've got retail. You can go and put your credit card into HSBC or Citibank or anywhere in the world. They also have an investment bank. They have credit cards. If you've got your Amazon credit card, it might be Bank of America. They have asset management divisions. So not only, they play every role. They support the customers. In fact, one of the big goals of a global bank is to be able to trace a customer from cradle all the way through to CEO. They want to give you a great experience at university. And then when you do your startup, they want to give you a fantastic business service. Then you go international, they want to give you great global banking. Then when you get really big, they want to do your M&A for you. Then when you get even bigger still, they want to do your commercial stuff and float you off. They want to do everything. And they'd love to be able to track you all the way through that if they could, and have you sort of led through because they don't want to lose your custom. So these are massive organizations. And that number has obviously, I heard the laugh earlier, that's real. That is the kind of order of magnitude that we're talking here. $10 billion is the price of running a bank. And that does include the data center cost. So, when you're existing on 5 continents, 60 offices, when you have 100 data centers potentially, that's a strategy error. If Chris is here, he'd say strategy error. You should have 10, but they end up with 100 because it's just so hard to move things forward. So this is going to leave me with some time for questions, because this is the challenge. Banks have gone through a really hard time, and no love has been lost in that process, undoubtedly. But they're necessary to the economy, and they've realized they have to change to sort out some fairly significant economic challenges they have to their own existence. There was a figure I heard recently that 55% of banking executives expected their firm to be merged with another firm inside the next 2 years. That's grassroots. There's no basis for that, but why do they feel that way? Maybe they can see what's happening. And back to Lloyd Blankfein's statement at the start, a low-cost provider. And now everyone's looking at the profitability of trades. If I've got all this infrastructure that used to maybe get me $7 to process a trade, now it gives me 1 cent. Do I want to still have that infrastructure? Well, actually, no, I don't. It's a very easy question. Give me a harder question, right? So it turns out the transformation that they're facing is mammoth. It's absolutely massive, and it will take a decade or longer to pull off. And it represents the transition of banking from one phase in its life, in its evolution, into a new phase. And I'm going to bring back Ford Motor Company. I started work at Ford Motor Company in 1993. You're going to work out how old I am now. And they were going through a hard time. They were, famously, the Japanese were out-competing them. Everything was cheaper. The quality was higher. And they seized on the fact that Toyota had 1,500 model variants and Ford had 1.5 million. And they realized that they had a problem. They can see how you can make 1,500 things cheap and great. You can see how it's harder to make. We're in the same place now, 20 years later, with investment banks. We have 1.4 million model variants, and people really only want to buy 1,500. And the regulation process that's been going on has kind of encouraged that, and the fear of eclectic contracts. So for people in this room, I would encourage you to, we didn't have, there are a lot of people here who weren't in banks. We encourage you to think about this industry, because some of the biggest challenges in IT lie in the banks. Now, it won't be this year. For a few of them it is this year. So a few of them have woken up and they're moving fast. But the rest of them are going to pick up pretty quick. So watch out for this happening and keep an eye on this industry. I think it's going to be a really interesting place for people like you and I to work. And it's going to require robust technical leadership. The fear of change, especially in business leaders who don't understand the technology, will be immense. And people need to say, yes, this is possible. Yes, this is a deterministic outcome that we can achieve. Yes, we can take you there. We're professionals. So that's kind of the challenge I'd leave you with. And with that, I'd say thank you very much. And are there any questions? Off the shelf. That's a really good question. That's a really good question. I think we will see that there's no slam dunk answer to that. The question was, will everything move to packaged software, essentially? I think for the top 10 banks, there's no vendor who can provide packaged software that does what they do, right? It's undoubtedly the case when you get to smaller regional banks that there will be a lot of that, and at which point going to the packaged software vendors and giving them compelling solutions is going to be a big supporting industry. But you're right, you're kind of hinting at the maturation of the industry and the fact that vendors will be able to supply into the space. But it's definitely the case that to be differentiated, you do need a considerable amount of your own technology. Otherwise, you're just average. Any other questions?
It's a great opportunity for John to answer a question on AMQP, which is sort of off topic, but it's very much to do with the environment we're working in. This is from one of you guys, John's opinion of AMQP 1.0, which is now obviously gone into a standard. So now's your soapbox time to...
And I'm video, Jack. You just turn off the camera.
No, leave it rolling.
It's really interesting, right? AMQP 1.0, right? So in making any standard, it's not the AMQ. What we set out to do, or what I set out to do with AMQP, was to commoditize and standardize messaging. And I didn't really care which commodity standard won, so long as you got the same sort of market penetration as TCP/IP or HTTP. We heard Chris earlier, if you're in the room, talking about HTML5, and the jury's still out. I think with any standard, it's not always necessarily the best thing. TCP/IP is not the best network transport, arguably. But you would not be able to sit here with your iPads doing this without TCP/IP. And that's the effect we're looking for. So with AMQP, everybody needs to be coming together. And what really encourages me is when you see VMware and Microsoft and Red Hat, who are your data centers are built out of their technology. And they're all on the AMQP OASIS committee. They're all supporters of AMQP. They all have implementations. So yes, we're going through the joy of shaking out a standard and all the different sort of version smear that you get with that. And Fix is a great example. It took 10 years for Fix to get to the point where it was standardized. But it didn't stop people from using it. HTTP 0.9, 1.0, 1.1 didn't stop people from using it. HTML 4.5.6 doesn't stop you using it. The prize is worth the pain. And I would say AMQP 1.0 is misunderstood in some ways because it actually can support all the semantics of the previous one, but we standardized it at a slightly lower layer than 0.91 is capable of. They're both great protocols. Embrace a vendor, use the product, you'll come out on top. That's what I'd say. I don't know if that answers the question, whoever it was that asked it. Okay, any more questions? Even on AMQP? No? We all done? Thank you very much for your time. Thank you.